Hello and welcome to Options in Plain English. Today we're going to talk about historical and implied volatility. These two terms are used by traders to refer to different types of volatility. And we know that volatility refers to price changes over time, how often they happen and how big they are. So something that fluctuates a lot, this is displaying a high level of volatility, and something that doesn't change very much is displaying a low level of volatility. But what are historical and implied volatilities? Are they two different types of volatility? Which one is the most important for us as option traders? Well, we have historical and implied volatility, and as I was mentioning, they measure different things. They're completely different things. And the reason they measure different things is because historical volatility refers to the past. And there's a hint in the name, historical. It's based on history. It's based on what already happened. Implied volatility is based on what the present tells us about the future. And this is the main difference between historical and implied volatility. The historical volatility is looking only at the past, something that already happened, and implied volatility looks at the present and what it tells us about the future. Now, if we dig deeper into this, how can I get historical volatility measurements? How can I get implied volatility measurements? Well, historical volatility is based on past stock prices. So notice here, we're not talking about options at all. We're only talking about stock prices, something that already happened. The prices that are already there, we measure them and we get a level of volatility in the past. Implied volatility, on the other hand, is based on current option prices, something that's happening right now and what they might tell us about the future behavior of stock prices or underlying prices in general, but based on prices of the options right now. So based on supply and demand, which is what ultimately drives the price of any financial instrument, and in this case, the price of options. Now, looking at historical volatility and analyzing past stock prices, what we're going to have is there is a formula to evaluate what the volatility of an instrument is. In this case, we start by looking at the variance. And notice here, I'm going to use the formula, but this is not the objective of this lesson. The objective of this lesson is that you get a good understanding of the differences between historical and implied volatility, not necessarily the formulas used to obtain them. But, we're just going to look at the formulas to give us a better sense of where we're coming from. So here we're looking at the variance. And the variance, what you do is these candlesticks are representing 1 day worth of data. So basically what you do is you look at every day compared to the close of the previous day, and then you square that difference, and you do the same thing over and over for all the different sample points. And at the end, all those square differences are added up and divided by, in this case, n minus 1, because it's the sample from a it's the way to derive the population information based on a sample. This is not necessarily important for you, but this is what the formula is telling us. So all those square differences divided by this, and we have the variance. And the volatility is the square root of the variance. Now, what is volatility actually telling us? Well, volatility tells us the how big that every change is expected to be. So basically, what it's telling us is it's the one standard deviation. So 68% of the time, it's going to fall. The change is going to fall within those ranges, plus or minus the amount of volatility. So for example, if we're looking here at this stock, which in this case is Alphabet, and the variance would lead to a volatility value of, let's say, 20%. What it would mean is, since volatility is expressed in an annualized form, it would mean that the price of Alphabet is expected to fluctuate from plus 20% to minus 20%. And that range would contain 68% of all potential outcomes in the future. So this is this is how confident we are that the underlying is going to be in between those ranges, plus or minus. So volatility as a percentage tells us the range that the underlying is expected to stay within. Now, it doesn't mean that it's going to stay there for sure, but it means this is what we expect. In this case, if we look at past stock prices, what we're getting is the information about how it behaved already. When we obtain volatility based on current option prices, we're looking at implied volatility. And in that case, as we remember from a previous lesson, the option price is determined by many factors, in particular 6 factors, which are underlying price, strike price, time to expiration, volatility, interest rates, and dividends. And if you take a look at these, the underlying price is known, the strike price is known because we're looking at every option. The time to expiration is known because we selected the expiration. The interest rate is known because it's the environment that we're in. And the dividends are known as well because this is what the underlying tells you, what the company tells you that it's going to pay out as dividend. So the only unknown is the volatility, which means that if we have a pricing model for the price of the option, we could take the price of the option that exists in the market and then calculate the volatility based on that price, since all other variables are known. So in this case, most traders use the Black-Scholes model to price their options. So you could apply these formulas. We're not going to look at Black-Scholes. It's a little bit complex, but just know that all these factors come into play to get the price of the option. And if we take the price of the option that is trading at for real, in real life, in the market, we could figure out, we could back out the price of the level of volatility that this price is implying. So these options are implying a certain volatility every time they have a price, because all the other variables are known. This is why this is called implied volatility. It's the volatility that is implied by the price of the options. Now, notice something else. Every option that has a price has a volatility or an implied volatility related to it. There is a one-to-one relationship between option prices and level of implied volatility. So if you take an underlying and you look at all the different expirations, all the different strike prices for both puts and calls, each price of each option is giving you a level of implied volatility. And this is one of the difficulties when we're trading options. Not all the levels of implied volatility are the same. What does that mean? Well, it means that even though we're looking at one underlying, and one underlying has a known and unique historical volatility, and we can calculate it, we just take some look back period in the past and we can figure out the volatility. When you look at current option prices, you have as many implied volatilities as different options this underlying has. So when you see one level of implied volatility for one underlying, what that means is it's somehow taking all these option prices getting all these implied volatilities and trying to get a blended value so that you can say, for example, in this case, Alphabet is trading at this price, stock price, and it has a certain level of implied volatility, let's say 40%. Well, that 40% might be 41 for this particular option and 42 for this particular option and then 38 for this particular option. So every option price implies a level of implied volatility. That's one of the difficulties when trading options is you have many implied volatilities. And at this point, it's not so important to concern ourselves with that. Later on, we're going to talk about that. But for now, what's important is to understand that the implied volatility is looking at the current option prices in the market by real traders based on supply and demand, bid and ask, and determining a price from which we can figure out and we can calculate the level of volatility. And there is one level of volatility for every option. Now, let's take a look at how this manifests itself on our trading platform. So now we're on a trading platform and we're going to take a look at that same underlying we were talking about, Alphabet. You can see the stock prices here. This is a price chart of Alphabet. This is 1 year worth of data. And based on these prices, if we go to our trading page, and I'm using Thinkorswim, but you might find this information on your trading platform of choice. It says here that the current historical volatility level is 59%. What does that mean? It means that in the past, if we apply a formula, we get the variance and then we get the volatility. The historical volatility is 59%. Now, is that important to us? It might be important to us because we can see how much this underlying moves. But in order to make trading decisions, we don't know what's going to happen in the future. And we need an estimate of what's going to happen based on current information. And the best way to get that information is to look at implied volatility. As I was saying, so before we go here, every expiration here, we have all of the different options and their prices. And every option based on their price implies a level of implied volatility. Here for puts, for example, for this expiration, May 2020, the puts, these prices imply these levels of implied volatility, 40, 41, 42, 43, etc., 39, 39, etc. The calls, the same thing. We have the implied volatility right here, 40, 41, 42, 43. Although they're not the same, they're just about they're very close to the same number, even though they're not the same. Now, if we look at further expirations, so with June 2020, for example, we have different levels of implied volatility, 36, 35, 36, etc. And this is for calls, and for puts, the same thing. So the one thing that we can notice is we have as many implied volatilities as option prices. And also because calls and puts, so they count as two different types of options and two different options in this case. And also, since we have all of these implied volatilities, how is it that if I go here, for example, and let me go here, right now, it tells you that the implied volatility of the underlying implied, so based on options, the implied volatility is 42%, 42.6%. How? Well, of course, they apply some sort of proprietary formula and try to get a single number. So they take all of the different implied volatilities. They probably weigh the ones that are closer to add the money with a higher proportion of value, so with a higher weight. And based on that, they also take different expirations and they put them all together and somehow come up with a single number. But notice that all these options are contributing to the implied volatility number, to the unique implied volatility that is usually displayed as being the implied volatility of the underlying. So for example, here in thinkorswim, not only do we have the implied volatility of every option, we also have a single unique implied volatility for the whole underlying, and then they also give you an implied volatility per expiration. So this number, for example, is taking into account only the options that are in this expiration. So you can see how even for different expirations, the implied volatility levels are not the same. Now remember, the implied volatility is a percentage number that is an annualized number. So this 40% and this 31% mean that in a year, these options are implying that the underlying is going to go either 40% up or 40% down, and that they're going to do this with a degree of confidence of 68% because they represent a 1 standard deviation move. And also, even though we are talking about an annualized number, this is only 6 days. This only has 6 days to go. So we have to get the number for this particular period. And we're going to look at that later on. But just know that this is an annualized number for every expiration. So anytime you see an implied volatility number, it means it's an annualized number. So this is more or less what it means. It means, for example, this one for June, it means that the options here are implying that the move is going to be between plus 38% from the current price and minus 38% of the current price. And we have a 68% degree of confidence because it's a 1 standard deviation move. Now, just to finish here, I want to show you a little study here that they have in for the price chart here. And what this is going to give you, and it's going to so this is graphically what that means. So this is where we are today, and based on the implied volatility that we have by this time, this is time on the x-axis. So by this time, based on the current implied volatility, we have a 68% chance or 68% probability that the price is going to be within these two values. And of course, more time passes, the range starts extending and expanding. So that's a visual way to look at what implied volatility means and how you can look at it this is called a probability cone. So this concludes this lesson. We have now taking a look at historical and implied volatilities, and now we know that historical volatility is based on the past, based on past stock prices, and that implied volatility is based on current option prices. And because of this, the most important one for us is the implied volatility one. So I hope that that concept is clear, and I hope that you guys stick around, and I hope to see you guys around next time. Thank you very much, and goodbye.